Welcome to the Daily Update, where I'll go over the action in the market for Monday, May 5th, and we'll see how things look for Tuesday, May 6th. Kind of like Edward Yardeni said, the well-noted economist. I get his newsletters. It was a Seinfeld day on Monday where nothing happened. So that's kind of what you could take away from this. But at the same time, we had 9 straight up days, and we were hitting overhead resistance. Some of our indicators, especially in the short term, were starting to look extreme positive. And you kind of put all that together, and it's not a real surprise that we had a pullback. We had some folks that wanted to lock in some profits. Now, what we'll be doing is evaluating things day by day just to see, okay, is this just a pullback? Are we still maintaining a more positive picture and improving, or are we getting ready to switch over into something more negative? We don't really know how that's going to play out right now. We just evaluate it day by day and then see what conclusion we reach. Okay, so right at the open, we did have a gap lower open. The futures were down about 0.75% right off the bat when they opened Sunday evening. They didn't open down 0.75%, but they drifted down there and just kind of went sideways. But that led to the gap lower open below S1 at 56.52. Then we found support, and sometimes it works out this way. We dropped below S1 and then found support at Friday's pivot. And sometimes a previous pivot can act as support or resistance. Then from there, we were able to climb back up to the daily pivot at 56.77. We got a little bit above the daily pivot and almost got to the unchanged level. That acts as overhead resistance on a down day. We didn't quite get up there. Then we saw, this is more negative, some late day selling going into the close, and we closed down back below S1. It was encouraging to see the resilience earlier in the day, but it was discouraging to see the late day selling going into the close, and that was a little bit more negative. We were down 0.64% on below average volume. And we are positive in the short and intermediate term because we're above the 20-period moving average in the short term, and we're above the 50-period moving average in the intermediate term. We're still negative in the long term and in a downtrend because we're below the 200-day moving average, and the 50-period is below the 200-period. Interest rates are creeping back up. We want to watch that. Now, we're still below 4.5%, but that was kind of what really started to rock the stock market a while ago because interest rates have been going up. We're in the 4.3 range now, but we just want to keep an eye on that after it looks like bonds had been stabilizing recently, which has been giving the markets a little bit more confidence, especially the stock market here. And then we want to keep an eye on what's coming out of Washington, D.C., what's going on between China and the U.S. as far as the trade war. Apparently, there's some cutbacks taking place in China, and they don't have a real strong economy right now anyway. And for them to be laying people off, that might be putting some pressure on their government, which may force them to the table and have Trump and China be able to talk with each other. There was an event over the weekend where a rocket got through and actually landed really close to the Ben Gurion Airport in Tel Aviv. Israel has some pretty strong defense mechanisms, but this one got through. We just want to watch that, and I mean, things are going on there all the time, but we just want to watch it and see if there's any kind of escalation. And then there's been some pounding down in the Red Sea with the Houthis. Both U.S. and Israeli forces are trying to take care of that. Okay, some comments. Right now, anyway, it looks like a pullback after 9 consecutive up days. Treasury Secretary Bessent came out and says he thinks we're very close to some trade deals. That's nice and that's positive, and the market might have liked that, but where's the proof? Where's the beef, if you remember that? We're not really seeing anything substantial yet. Okay, we can see things being fed out to the market that's trying to keep things a little more positive, but at some point, the market's going to want to see something, and citizens are going to want to see something too. Mega caps and growth underperformed. They've been coming back and showing some strength recently. Not really a surprise that we're seeing some pullback in both of those areas. And then oil prices, they continue to fall. This is not inflationary. We're getting down into the 57 level. OPEC Plus now, came out and said that they're going to increase the oil production in June up 411,000 barrels per day. And that puts more onto the market, which pushes prices down. And the VIX is back above 23 at 23.64. That's more negative. We're also still above 20, which tends to be more negative. Here's our short-term list. Now, the Stochc RSI, Williams percent R, CCI 1420, even the stochastics. These are the usual charts that come on this list. They're positive when we're going up. They're negative when we're going down. That just shows that there's across-the-board short-term conviction. The other indicators on here we don't see as often. The rate of change going back 10 periods and 20 periods is extreme. The slope oscillator, it's still looking really extreme. We're still far away from the 20-period moving average as measured by the boom indicator. And then the 20-period moving average study, we're still above 80% with those stocks in the S&P that are above their 20-period moving average. In the intermediate term, the CMB composite, it's coming down a little bit, but still extreme. The TTM squeeze, it just keeps going up. The McClellan oscillator for the S&P, now after Friday, the NYSE McClellan oscillator was on this list. It dropped off, but the one for the S&P is still on here. The PMO studies, these are all of the PMOs, the price momentum oscillators inside of the S&P 500. All 503 of them, and there's a number of different studies that go with that. We're looking extreme with that, and we're also still extreme with the bullish percent index for the S&P and the NASDAQ 100. That was one of the more encouraging things that we saw in Monday's session. Even though we had a down day, even though we're seeing some weakness drifting in, the bullish percent index for the S&P continues to go up now, but it's also looking extreme at the same time. And we're coming down a little bit here, but we're still extreme with the advanced decline oscillator based on 10 periods. No change to the overall scenario. We'll see if that changes. The Fed is meeting starting on Tuesday. They'll make their announcement on Wednesday. Pretty much locked in that they're not going to change rates. It's not what they're going to do. It's what are they going to say, not only in their statement, but the report that they release, and then the press conference with Jerome Powell. The market's really going to be tuning in to see what kind of clues can be had from all of that. The dollar was down and interest rates were up. We're getting up to that 4.34%. We're still below 4.5%, so it's not like we're brushing up there. But the last couple of sessions has seen interest rates going up, so we just want to keep an eye on that. Where after Friday, we were at 4.32% with the 10-year yield. We're turning positive now as far as sentiment. Do you think there's some, FOMO, fear of missing out? Folks are feeling more positive about things. Do you think, oh my, I'm going to get left behind. I better jump in. That could be a bit of what's happening right now because we were under 25 there for a lot of March and most of April, and now we're seeing sentiment start to improve. We're coming in at 57 now. And the 10-year to the 3-month yield, it's actually doing okay right now. I'll show you the chart later on. Now, this is one change. We had switched over to positive with the ADX. That's the main indicator that I use to determine the condition of the trend. We had switched over to positive with the short-term ADX and even a little bit with the intermediate term. Well, with the down day on Monday, we switched back to negative. But it is weakening. The ADX is still below its moving average, and it's coming down, but it's still above 20 for right now. And because of the down day, the bias is positive. That's usually up day, down day. And then the momentum of the last number of days taken together, that is still positive for right now. We just had a couple of economic reports that came out here. The ISM services, this was a big deal. This actually showed some strength in the market. This may have pushed interest rates up a little bit because we were at 50.8. When we're above 50, that shows expansion in the services area of the economy. That's good. And we're more of a service-based economy these days instead of being industrial or agricultural. Most things in the U.S. are service-based, but we came in at 51.6, higher than the 50.2 that was expected. That's taken as positive right there. And the global U.S. services PMI, really not much of an impact there. It was down from the previous reading at 51.4. It came in at 50.8, but it's still above 50. So it's showing some expansion there. So here's the main chart, the non-manufacturing, or what you can also call services, the ISM. Or we look at the blue line here, which is coming down actually a little bit with the total, but still looking okay, and we're still above 50 for right now. And then the prices are coming down. See, this was actually kind of positive. When we saw the market going up after the negative open, it was because this report comes out 30 minutes after the market opens, and it could have been induced a little bit by this report because this is kind of a big one. So we're seeing inflation, or prices anyway, actually coming down. Then this is something, and if you watch any of these videos very often, you know that I like to rag on Jim Cramer. And, I've read a few of his books, and years ago I used to watch him, but unfortunately he's created kind of a cult following, and he's got about a 50% record from as good as I can tell. But the joke is, especially on Twitter or X, that whatever he says, the opposite is going to happen. He's known as a contrarian indicator in that regard. And Jim Bianco, who's somebody I do kind of follow, not really often, but I follow him on Twitter, and then he speaks on some podcasts that I listen to from time to time. He posted this and just said, consider yourself warned. Cramer comes out, this was on Friday, and says there won't be a U.S. recession. Okay, so according to this, that means we will have one. All right, then, more good news for the bulls. How does the S&P perform after recovering 50% of the bear market? Okay, and that's pretty much what we have done up to this point. And you can see here's all the statistics down below, and then here's the triggers up here. And it's usually pretty good going forward. Sometimes it doesn't last all that long. Sometimes it leads to a nice good run after that. And we can look here, and it's hard to see because they had two charts together with this one. The average return, we have it 1 month, 3 months, 6 months, and 12 months. The longer out you look, the better it is. It ends up being 100% positive with returns up over 18%. And it's okay, but not great. 1 month out, it's actually less than 50%. So we might see some pullback first. But then as you go out further, 81%. Then we get up to, I believe this is 68% here. But still positive nonetheless. Then consolidated equity positioning. This is our folks in stocks, out of stocks. They had really been getting out of them. That's when we dropped below zero. Now we're starting to see them coming back in here. And then the quarterly year-over-year earnings per share growth. And I go over this in the intermarket analysis video. I look at factset.com, and they put up a couple of blog posts during the week, and I usually cover those over the weekend. And coming in here to where we're at right now, and this is what FactSet is saying. In fact, you can see FactSet here at the bottom. It's about 12% above what was expected. And so that's good. Now, it's lower than what we were seeing before because we were at 15%. We're coming down to 12% so far. So that's why there's been this kind of exhaustion with some of these stocks, because they're still positive with earnings, but the earnings are being revised down. But it's still coming in as of right now. There's 72% of stocks that have reported in the S&P. So there's still a quarter or so left to go there. Then buybacks, and this is seen as something positive. And a lot of companies are coming in and announcing buybacks. Now, when they come out with their earnings, they go into a blackout period. And they can't do anything during that time. They can't even really announce anything during that time, because that usually has an impact on the market. If a company is coming in and buying back its own shares, that's taken as a real vote of confidence in their stock. They're using company money to buy that. And that also makes fewer shares available on the market, which also, they're more precious. And so they end up going up in value that way. But we're seeing really high numbers right now. In fact, I think this is a record high here for the number of buybacks. So if companies are buying back their own stock, which usually only happens when we're going up, that's a vote of confidence for the market. Then I also go over this over the weekend with the PE ratio, or price to earnings ratio. And then here they had another post showing that the NASDAQ 100 is still the most expensive. This area right in here, when we get above 20, that's when a particular index is considered to be expensive. And we're above that with the NASDAQ 100, and that's growth, and that's a big part of the S&P 500. It's coming in at 25. I still don't necessarily agree with this one. I show the forward-looking PE ratio, or NTM, next 12 months. I show it around 14 to 15. In fact, we were even dropping below 14 here with the small caps. But I'm looking at the S&P 600, which is the index for the small caps. This is the Russell 2000 small cap index, and it's coming in with these stocks still being expensive. And if that's true and people are reacting according to this, that's still putting more pressure on the small caps. Where the S&P 500 is right around 20, so it's right on the border of that being expensive looking forward. The equal weight, because it's the mega caps in the S&P, that's really driving the PE ratio up. But when you treat all the stocks the same, coming in a little bit more fair. 15 is considered fairly priced, Goldilocks. And we're right at about 16 there with the mid caps coming in at 15. But mid caps and small cap, they've really underperformed actually the last couple of years, but especially in 2025. They were the first to really start heading lower when we ran into some difficult times. And then the median path of the S&P 500 during 10% corrections going back to 1950, and then what's happening right now. So that's in orange. And then when there's no recession, then we do pretty good after that. When there is a recession in the next 12 months, we don't do so good after that. And that's what we're trying to figure out right now. And incidentally, I do have a separate website, and I just updated the recession supplemental video that I post there. And if you're interested in that, please feel free to go check out the website. There's a link below this video that will take you to the website. Traders grow more bearish amid tariff war with the dollar. And yeah, that's been under pressure, which is, again, goes against what you would think. When the dollar was really going up here, that's when all the tariff talks were first starting to develop. And usually that's a sign of protectionism, and a country's currency will go up. Well, it was doing that. And then we kind of hit this extreme reading here, and we've just been going down ever since. And then the probability of a U.S. recession beginning in 2025, according to Polymarket. This is one of the online betting sites. So we'll have to see how this goes. They're coming in at 57.5. Now, I don't participate in these sites. I was tracking them for the presidential election. I don't track them for sports. You can bet on anything that moves. I don't know if you can do this for free or if you have to pay. Where people in the stock market, they're putting up real money here, where they're coming in at 24.8% as a probability that we're going to go into a recession. So we'll have to see. They've been tracking rather close, but now we're seeing a disconnect between the two. This is the Main Street meter, which we tend to use, especially when it's getting extreme. We use it in a contrarian manner. And you can go back and see other times, like the year 2000, this was the dot-com boom. And then after that, the dot-com bust. And then 9/11 happened in here. And then 2003, that's when we finally bottomed. And then 2007, this was right before the great financial crisis. And then we bottomed in 2009. So we use this more like a contrarian indicator. And then 2020, after we were just screaming to the upside after really coming down, we hit extreme up and extreme down because of the lockdowns. And then we've been coming back up in 2024, but we've been coming down in 2025. And this is the average annualized returns forward 1 year and 3 year when the Main Street meter, where it's based at on this chart. And it's pretty good going forward. It's currently in the 25th percentile here. So that's pretty positive looking forward. If you get enough folks that are completely pessimistic about the market, that's usually when it does the opposite. And just like when everybody's euphoric, that's usually when you start getting ready to head for the exits. This is a chart put out by Edward Yardeni, where it has three different things that we measure on this chart. The blue line is the market cap, and those are the biggest stocks. Then the red line, these are the forward earnings. And I do track that every week, and we're coming in at 22.6 there. And then the share of forward revenues, that trails behind here, but it's still continuing to go up at 11.8. All right, here's the intraday chart. I still have this dashed line here from Friday because we tried to get up to 5,700 and that acted as overhead resistance, which is a psychological level because it's a round number. Now we'll see, are we going to be able to get back above that? Well, we did gap down lower. We gapped down below S1. We actually found support here. It's a little hard to see, but this is a dashed line from Friday's session. And then this was kind of the resilience that we saw. The market was making an attempt to come back up. We hit the daily pivot, and then later in the day, we're actually able to break above the daily pivot and not quite get to the unchanged level. This was the more discouraging part of the day, where we saw late day selling. It's the amateurs who open the market. It's the professionals who close it. So this ended up being a little less positive by what we saw going on later in the day. And we're pretty much flat right now, down just a little bit with the futures. We were pretty much flat in the Sunday evening, and then we started to drift down right when they opened. And we were down about 0.75% even before the market opened, and just kind of stayed there. And then we did see a little bit of an improvement throughout the day, and then closing down near S1. And this is still looking positive, even though it's declining. We still see the blue line above the red line. We like that. That's growth outperforming value intraday. We still like this. This is intraday growth to value for the S&P. This is still going up for the most part. The end of day charts, everything was down, but growth was down less than value for the large caps, mid caps, and the small caps. So here's the end of day chart for the small caps. Still going up, still barely hanging on to an uptrend. Also still in an uptrend with the mid caps and improving. Still in a downtrend with S&P growth to value, but improving nonetheless. So we like that. And we're coming still into the middle part of the rainbow when we look at the growth versus value ETF here. And trying to improve, but still going in a downtrend when we look at discretionary to staples. We need discretionary to perform better. It's coming back, but staples have been just kind of chopping along sideways. That's more defensive, toilet paper, toothpaste. Where discretionary would be like Tesla, Amazon. This is more almost growth-oriented here. We want discretionary to really outperform, and that's what it does in a more positive environment. But we're in a downtrend here with this overall ratio. We crossed over positive after Friday, and you probably have to look over here on the left. We're at 23.8 with the green line. We're at 24.05 with the red line. That means the red line's higher than the green line. That means we're negative here in the short term. We also dropped just barely here. We're seeing 24.28 for the green line, 23.68 for the red line. We're dropping down negative here. And let's see. Okay, I have these backwards here. This is the intermediate term. Then we have the short term. Now, we're not trending in the short term. We're actually dropping below 20 right now. So that means we're not trending at least on an ADX evaluation basis. We're going to be watching this previous chart. If it drops down below 20, that's when we're likely to go into some sideways chop for a while. And there's a whole different series of strategies that you can implement when we end up going sideways. If you want to learn more about those, please click the link for the website that I have. And we still are below average with volume. We continue to drop off. You could take this as more positive because it was a down day and we were below average with volume. We've been concerned since we've been going up on below average volume, but now we actually saw the opposite of that. And we get this every week. This is more of a composite of different sentiment gauges coming in at 55.95, so we're neutral now. And this is kind of lining up with what we're seeing. We're tilting more. We're at 57 with the index that we use every day, and that's actually going over. I would have it positive. They have it listed as greed here. And coming down a little bit here with the legal insider transaction ratio. So that could be bullish for the market as well. When I show that chart, I like to show the insider buying ETF. These are legal insiders that are buying, and this gets hit with market forces just like everything else. It's in a downtrend, but just as we've been recovering with the indexes, this also has been coming back up. We're back above 23 with the VIX. Anytime we're above 20, that is more negative on an annualized basis. And coming back up, it's still below the moving average with the VIX of the VIX. The momentum for the VIX, though, is still down. That's positive. And not much of a move here. Ticked up a little bit with this fear gauge, and you can barely see it, but we ticked up just a notch here with this other fear gauge. Going up with the equity put call ratio daily chart. We're going back up with the 5-day chart, and we're still declining with the 10-day chart. Getting a very low reading with volatility risk premium, so we'll see. So we don't see very many low readings here. Is that going to mean some kind of a change is in the wind, or are we going to get set to go sideways for a while? We're still positive with the advanced decline line based on price and volume, even though they tick down. They're still above advancing moving averages. This is the 10-day advancers minus decliners that's developed like an oscillator. We're actually still going up here, which is positive, but you can see we had a really extreme reading about where we're at now. And yeah, we fell after that. But other times we had really extreme readings. We chopped sideways, at least for a while, and then ended up dropping after that. Where here, sometimes we just kind of go sideways for a little while. Not necessarily signaling a reversal, but it could mean that things are going to slow down for a bit here. And we were getting extreme with the short-term advanced decline ratio. That's now pulling back. And we're still slightly improving here with the new highs versus new lows. The 5-day is going up and the 10-day is trying to go up ever so slightly. We're positive with accumulation distribution. It came down, but it's still above the advancing moving average. We're positive with Chaikin money flow. That's smart money indicator number 2. We're negative, though, with the Chaikin oscillator. And this picked up something negative on Friday. This actually declined below its moving average on Friday. And it's not liking some things that it's seeing right now. One of our 3 smart money indicators is looking more negative. Coming down, but still positive with the vortex. We're still above the moving averages here with our advanced decline line studies. Coming down a little bit, but still extreme with the percent of stocks in the S&P above their 20-period moving averages. And here's the study that goes with that. This is the same thing. It's just the chart has a little bit different format here. I start paying attention to this when we get above 70, but we really start paying attention to this if it gets above 80. And it's above 80 right now. And then those stocks above their 50-period moving average has turned positive but pulled back on Monday. Still below 50 with the 100-period moving average study, declined, and below 50 with the 200-period moving average study. And still above the 50-day moving average. We're still having a difficult time with this previous pivot point here. That's providing overhead resistance. That's at right around the 5,700 level. If we can get above that, then we have the 200-day moving average above current price. Then on the bottom, we did drop off with volume. And coming down, but still mainly positive with the 20-period moving average study, still above 50 with the 50-period moving average study, and just a little bit below 50 with the 200-period moving average study. 50 is kind of the line in the sand between positive and negative. And then we have our usual charts that are showing good short-term momentum. The Stochh RSI, the Williams percent R, the CCI 14, and the CCI 20, and then the stochastics coming down but still extreme in the short term, intermediate short term, just starting to come into extreme territory with the long short term stochastic. Force index declined but still positive. The condition of the short term trend, even though we had a down day, the lines are still going up. We haven't come back down to the double or triple exponential moving average, at least yet. So we're still above the simple and exponential moving average based on 20 periods. That's why we're positive in the short term. The rate of change, this is kind of big though. Going back over the last 10 periods, we had been extreme negative. Now we're getting quite extreme positive. Other times when we had readings like this, didn't necessarily mean a reversal, but it could mean some kind of a slowdown. And we're still positive here. We're going up with the midpoint, and we're in the +2 channel with the standard deviations chart. Now we switch to the intermediate terms. Still above the midpoint with the balance of power. Coming down but extreme with the CMB composite. Still switching over from negative, kind of positive negative with the lighter purple. Now more positive neutral here, I guess, with the brown bars. They won't actually turn positive until they turn blue. And we are improving here with the highest high, lowest low value. We're above the midpoint. The midpoint's going up. The blue line, which is the highest high value, that's going up. We're starting to level off a little here with the lowest low value. And we're positive here with the Landry light. It's really hard to see because the longer this lasts, the bigger these bars become. And we're green now in an uptrend here. And we're improving here with the bow tie. The fluorescent green is starting to come above both of the other moving averages. And this is the shortest term moving average. And that's when we see things more positive here with this chart. We're still negative, though, with the proper order. Now, going down, these, again, the longer this lasts, the bigger these bars become. But the background is red, so that's negative. And the TTM squeeze just keeps going up, and it's well above this black line, so it's extreme negative. This is a longer-term look at that same chart. A much higher reading than what we've seen on this chart. And we're extreme in the intermediate term with the rate of change going back 20 periods. And standard deviation, we're above the moving average. Even though it's dropping down, it's still showing that the speed of movement right now is pretty intense. we're coming down, but still above zero with the ease of movement. This tries to measure the path of least resistance. And we actually saw the Arun indicator wake up. We had been below zero here with the oscillator. That means that sellers were in control. We suddenly shot up here and are getting a positive reading showing the green line, which are buyers. They're now becoming more in control. And coming down, but still barely extreme, is the S&P McClellan oscillator. Now, when it's above zero, we're going up with the summation index based on price, and we're also going up based on volume. That's still looking positive. We were extreme after Friday with the NYSE McClellan oscillator. Now we're pulling back down, but we're still above zero. So we're going up with the summation index based on price and volume for the NYSE summation index. We're coming down here with the swell trading oscillator, declining a little bit based on price and volume now. But momentum is still positive. The PMO is going up. We're going up based on price and volume. We're extreme with the PMOs inside of the S&P that are rising. We're also extreme with the buy signals, and we're continuing to go up and look positive with the PMOs that are above zero. This is the condition of the intermediate term trend based on 50 periods. Still above both lines. The blue line and the red line are going back up. This is what we actually use, though, to determine if we're positive or negative. We're above the simple and exponential moving average based on 50 periods. Now we're starting to deal with the 100 period moving averages. We're kind of battling around the 100 period exponential moving average. Here's all the moving averages together. We still have the 200s looming above current price. First, we'll have the exponential. That's this kind of darker gold. And then the purple line, that's the simple moving average. Then looking at the boom indicator, we're still far away from the 20 period moving average. And when we get far away from that, price has a tendency to bounce back. And then these are anchored moving averages here. We were above this lighter blue line here. We recaptured that on Friday. Now we're bumping into this orange line and we're coming back down slightly, but we're still above the light blue line for right now. And this is extreme. This is a short-term oscillator here. We were extreme negative. Now we're extreme positive, and it's beginning to roll over, though. And the MACD is crossing above the midpoint. This is more short to intermediate term. That's positive. And all of our momentum oscillators are positive. The one that we're concerned about is the one that I had the other chart for, the slope oscillator, because it's becoming extreme positive. And we're going up still with the Copic curve. That's positive there. Kind of flat, but still in this more yellow area, showing improvement with the Sean trend meter. Still above 50, even though we declined with the money flow. Coming back down, not extreme any longer with the ultimate oscillator. Coming down, but still above the moving average, which is starting to turn up when we look at on-balance volume. Above 50 with the RSI 14, that's intermediate term, and the RSI 9, that's short term. And we've gone from positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're still going up here with the bullish percent index. It's crossing. Now, we pay more attention to this when it goes above the green line. It was already barely extreme after Friday. It's continuing to go up. That's actually encouraging to have a down day and to see this going up. This measures the point and figure buy signals that are being triggered inside of the S&P. And we're going up and showing an improvement here with the NYSE bullish percent index. And we're also extreme and kind of leveling out with the NASDAQ 100 bullish percent index. Now, looking at the mass index chart, we have to look at the context for what created this signal. The signal is when we come back down below the red dashed line. We were going up, and that caused this signal to be generated. So this is trying to anticipate a reversal. And support and resistance, I pointed this out over the weekend. We came right up to this 61.8% retracement level. Now, this goes from the lows a year ago, April, to the high set in February. And we came right up to this level, and we're coming back down. But this is positive. If we can stay above it, it'll stay even more positive. The pivot point was recaptured last week, and that's the 55.75 level. And we're still above it, even though we declined in Monday's session. We're still looking good here on a trending basis. The Heiken Ashi has open candles. That's positive. We're turning positive again with the Kegi chart. It's black and pointing up. The Renko chart has open blocks. That's positive. And we're going positive here with the 3-line break. And we're still looking okay with our 150 and 200 period moving average study. After we drop down below these green lines, we're showing some improvement there. Then we're still positive in the short term with all the different indexes. We're negative in the intermediate term, and mid caps and small caps are still negative in the long term. And we have bonds, commodities, and the dollar negative across the board on all time frames. And you had communication. That's encouraging. That's growth. It was up, where the other areas, energy's just been getting hammered. And then, of course, oil going down doesn't help that. We want discretionary to be doing better. It was one of the worst performing areas. And we want tech to do better. And it was also down on the day. So we saw growth take a bit of a hit there, but we saw value take a bit more of a hit. And we had some negative things happen right after the open. The dollar below 100, the NASDAQ below 17.9, even Canada dropped below 25K. And then we had staples have a BPI cross back above 50. That's not as encouraging. Staples are toilet paper and toothpaste. That's more defensive. This is a new chart. Some of you might use this on a pretty regular basis. This is called a market carpet. Okay, and we have all 11 sectors in here. I'm going to do this. I tend to find this a little bit overwhelming to look at it, but we can just look in a series of color, whether if it's red, that's negative. If it's green, that's positive. If it's gray, that's more neutral. But we have the tech sector, financials, discretionary, all 11 sectors are here. And you can see the really big stocks, they suffered. That's why we were lower, except for Microsoft was up slightly. And then you have the other tech companies that make up the tech sector. Then we have financials here, and then healthcare, discretionary. We want this to do better, but it didn't. Tesla and Amazon were down. Then industrials, that's more cyclical. Staples, that's more defensive, and you see there's some green areas in there. And then communication, that's another growth area. Now, Netflix, last week it was just setting new all-time high after new all-time high. So yeah, some people are going to want to come in and lock in some profits there. And then energy and utilities, real estate and materials. And you can see by how big this box is, how much of an impact it has on the overall index. You can see tech with the biggest box here and lots of companies, it has the most influence. And the Dow, we were coming up to the 50-period moving average here, and we're just still dealing with that as overhead resistance. We're still positive, though, with the diamonds when looking at the Elder's Impulse system. And we're above 50 with the NASDAQ, the 50-period moving average, but we're in a downtrend here. And we've gone from positive to neutral with the NASDAQ, and we were hitting the 50-period moving average, but we're hitting resistance at the 50-day simple moving average for the NASDAQ 100. And I pointed that out over the weekend, and that's kind of a big deal. A big part of the S&P 500 is the NASDAQ 100, and so we're just going to see if this is turning into something a little more negative. We've gone from positive to neutral with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. And believe it or not, we're actually hitting resistance here with the S&P 600 small cap index. It was coming back up to its 50-day moving average. So we also had the Dow earlier. So you had a lot of indexes, plus a whole lot of things being overbought at the same time can add to a pullback type situation. Now we're above the 50-day moving average here with the Russell 2000 small caps. I'm going off of the S&P 600 small cap index when we're hitting resistance. And we've gone from positive to neutral with the small caps with the Elder's Impulse system. The mid caps are above their 50-day moving average and still positive with the Elder's Impulse system. The Wilshire is still above its 50-day moving average, but we're in a downtrend here. And we're still above the 50-day moving average with the total U.S. stock ETF, but still the 200-day looms above. Financial sector was down, but still above its 50-day moving average, hanging on to a little bit stronger uptrend currently. The FANG index, in a downtrend, just generated a death cross, but since that time, we've been going back above both of the moving averages. Microsoft was up 0.2% above its 200-day moving average, but still in a downtrend. Amazon was down almost 2%. It came up to its 50-day moving average and now is starting to come back down. Apple, which seems to be taking it harder with this tariff thing that's going on, it's in a downtrend. It also declined over 3%. Google in a downtrend, still above its 50-day moving average. Meta is coming back above its 50-day moving average. Nvidia in a downtrend, still above its 50-day moving average. Tesla kind of in between its 50 and 200-day moving average now, down 2.42%. Netflix, again, just setting new all-time highs here. Well, it declined almost 2% on Monday. And then the staples to tech ratio, this bounced back up a little bit on Monday, but this decline, that's actually positive. We want staples to be underperforming tech. That means that value was underperforming growth. And we want this ratio to continue to come down. Now, the problem is this ratio is in an uptrend right now. So we need to see this continue to drop off. And then looking at this SPY to staples, again, SPY to defensive or value here. This is still giving us some concern because this is falling apart in kind of a similar way to what we saw at the end of 2021. And we don't know if it's going to actually lead to what we saw in 2022, but we want to keep an eye on this anyway. And then looking at the relationship between U.S. and world stocks, getting a little bit stronger in the short term, leveling off and trying to turn up a little bit here in the long term. Oil dropping down more into the mid-50s, and the dollar back below 100 and in a downtrend. This is Truflation's chart for their measurement of inflation in the U.S., coming in at 1.46%. And we are going back up with the 10-year yield here, but it doesn't look all that crazy, at least yet. Now, if this continues to go up, that's when we'll get concerned. And then we're coming down now with the 10-year based on price. We're going back to being non-inverted with the 10-year to 3-month yield curve. So now we start to watch our recession charts a little more closely. Now, a lot of people don't use the 10-year to 3-month yield curve. They use the 10-year to the 2-year. And I use that one too. But this one had gone inverted again. Now it's back to being regular. All right, and then we're still doing okay here with our Q to S&P ratio. We're not doing really well with discretionary to S&P, but we are doing all right with large cap growth versus large cap value. Looking pretty good here for right now, above advancing moving averages with the large caps, mid caps, and small caps. So what's our outlook for Tuesday? We're still positive in the short and intermediate term. We're still negative in the long term. We are going to get the trade balance. Not a huge report. It doesn't seem to have much of an impact on things. And then keeping an eye on all the crazy stuff that could happen, and tariffs and trade wars. That's probably what's going to have most of the impact on the markets. Then here's a look at the economic calendar. We're going to get the Fed decision at 2 p.m. Eastern on Wednesday. We are keeping a close eye on initial jobless claims, and then we won't have any economic reports on Friday. And there will be a 10-year note auction. I don't usually track those things, but this calendar does. If it has good reception or bad reception, it can have an impact on the market. Seasonality, not very good for May 6th. Negative with the Dow, neutral to negative with the S&P and NASDAQ. But when you look at it during a post-election year, it looks okay. The green dashed line, that actually shows positive seasonality here for the next few trading sessions. But we have really strayed away from seasonal patterns that we usually see. So take that with a grain of salt. And then this is a new chart that I post every day on the YouTube community tab, but I wanted to start including it here. These are the pivot points for Tuesday. And the cool thing about these is they're predefined. We know these before Tuesday even happens. And you can see I found the 10-minute charts to be the most accurate here. And you can see where we've lined up really well before. So this is a good tool just to keep an eye on things. All right, the warning signs, we're still looking negative with our longer-term growth to value ratio and our longer-term discretionary to staples ratio. The swelling trading oscillator is now back to negative. Then looking at the moving average studies, we're looking okay with the 20 and 50. We're above 50 there, but we're extreme with the 20. We're still below 50 with the 100 and 200 period moving average studies. And the long-term special K, which I show in the deep dive video over the weekend, that's still negative. So the positive side here, we're really getting a mixed picture though. You look at our 3 smart money indicators. Accumulation and distribution, that's positive, as is the Chaikin money flow, but the Chaikin oscillator is negative. And then our S&P and NYSE McClellan oscillators and summation indexes are positive. And the reason why they're colored gold here is I consider them primary indicators, as are the bullish percent indexes, the parabolic SAR, and the 20-period moving average study with extreme with 2 R's. Isn't that nice? And we're still positive when we look at momentum. Ease of movement is positive. The money flow is positive. Ultimate oscillator just coming down from being extreme, but it is positive. The vortex is positive, another primary indicator. The financial sector is positive. And the momentum for the NASDAQ 100 still is positive, as well as that mass index reverse signal that potentially might lead to something. Okay, our conclusion. We are positive in the short and intermediate term. We're still negative in the long term. In the short term, we're positive, but declining from being overbought, also hitting some resistance as well. And in the intermediate term, we are improving, but pulling back. And we had a few indicators that are looking extreme positive. And in the long term, we're still negative because we had a recent death cross. That's a downtrend. And we're below the 200-day simple moving average. Thank you. I hope you found this helpful. Have a great day, and I will talk to you in the next video.